Good morning and welcome to Charting the Markets on Friday, the 24th of March 2023. Let's begin by having a look at today's economic calendar. And at 1:30 p.m. we've got US durable goods orders out for February, and we expect orders to rise by 0.5% month on month and by 0.4% excluding transportation. And then slightly later on at 1:45 p.m. we've got US flash PMI data out for March. And we expect manufacturing PMI to fall to 47 and services PMI to fall to 50.1. Now, the tone remains cautious with regards to most equity indices. And we saw in Asia, for example, most of these ending the day in red territory. And this morning, when you look at the US market, for example, and overnight, and also European markets, they're all selling off. And this is in the UK despite retail sales surprising to the upside and rising by 1.2% month on month in February from an upwardly revised 0.9% gain in January and versus an expected rise of 0.2%. And as we can see here, the FTSE 100 is falling very sharply on the back of basically the global banking sector remaining mired in uncertainties, even after the Treasury Secretary Janet Yellen yesterday, for the fourth time this week, spoke to authorities and basically said that the US Treasury is prepared to take more action if needed to stabilize US banks. But this prompted investors to sell off equities because they are now worried that she might know about another bank which might be at the brink of collapse, and therefore is worried about, investors are worried about this having a domino effect and leading to lower equity levels. So we can see here the FTSE 100 sending off very sharply and once again trading below the 200-day simple moving average at 7,429. And heading back down again towards this support we saw at the end of last week around the 7,317 to 10 area. So that will be the next downside target ahead of the low seen at 7,204. Now, for the bulls to basically try and get control again of these markets, what we need to see is for the FTSE 100 to hold above 7,204, because failure there would really mean that the recent decline we've seen the recent sharp decline we've seen over the last couple of weeks is in that case likely to continue if we were to fall below 7,204. And we would then head back down again towards the October low at 6,705. So this 7,204 level, this week's low, is key for the medium-term trend with regards to the FTSE 100. For the bulls to be back in control, we really need to rise above this week's high at 7,587, and then ideally also take out the previous support, which is now, because of inverse polarity, acting as resistance between 7,708 and 7,724. But right now, as you can see here, we are on track to have 3 consecutive days of lower prices with regards to the FTSE 100, as the banking crisis seems to be ongoing, at least with regards to sentiment of what the market expects to happen going forward. And the same picture you can see here on the DAX 40 contract, which actually rallied very sharply from its low seen on Monday at 14,459, and it did rally into resistance here, as you can see, the mid to late February lows, but then came off again on these comments by Janet Yellen, which in a way are kind of strange, because she is now saying more clearly that the US Treasury would support failing banks and the depositors in those banks and make sure that their money is safe. But that is being interpreted negatively by the financial markets, as I just said. So you can see here the DAX 40 is approaching the 13th of March low at 14,885. That offers some minor support ahead of the high seen in December at 14,677. But again, here, what we need to see for further upside to become possible from a medium-term perspective is that the DAX 40 remains above the 14,459 low we saw this week. Because if it doesn't, then the way is open for the 200-day simple moving average and also the December lows between 13,887 and 13,697 to be retested. And when looking at US markets, the Nasdaq 100, which has been outperforming this year to a great extent, actually traded levels last seen in September intraday on Wednesday, when it rose above the February high 12,896 on this daily financial bet to 12,947. And since then, it has traded sideways. So it is not coming off as heavily as the European markets we just looked at in the overnight session so far. But you can see that we are currently testing the accelerated uptrend line, and we may short-term revert lower and perhaps fall back to Wednesday's low at 12,545, below which we also got some support at 12,467, the early March high. Now, the Nasdaq is quite interesting because if it continues to hold, and as long as it remains, technically speaking, above its low seen in mid-March at 11,675, the odds would actually point towards further upside being seen, and the Nasdaq 100 perhaps rallying all the way back up again towards last August high at 13,722. So really a strong market here, much stronger than the other indices that we can see in the US and also in Europe. Now, the ongoing banking crisis has also had an impact on the US dollar, which has once again appreciated over the last couple of days as flight to safety flows into the dollar out of other currencies push the US dollar higher. And the inverse of that we can see on the euro dollar chart, and you can see here the daily financial bet of euro dollar is currently coming off and is doing so quite rapidly, having slid through the accelerated uptrend line, and is now on track to reach the breached February to March downtrend line, which because of inverse polarity now acts as a support line, and that comes in around the 107 area. And that's kind of interesting because the euro actually appreciated by about 3% over the last week and a half to 109.29, and now because of the risk-off sentiment again rearing its head, is coming off very sharply. So we'll have to see whether we can hold around this breached downtrend line, which now becomes a support line, and also where the early March highs were made, sort of between 107 and 106.80, and then maybe hold there and reverse higher, or whether further sharp downside is likely to be seen, in which case we would once again head back down again towards the February and early March lows between 105.30 and 105.16. But let's see where the week ends with regards to euro dollar, and then we can have a clearer picture at the beginning of next week. Euro sterling is quite similar. Here we saw a sharp sell-off in euro sterling, perhaps on the back of better than expected UK retail sales data coming out this morning for the month of February, where we had retail sales unexpectedly rising by 1.2% versus an expected 0.2% gain, and also versus revised and upwardly revised 0.9% gain in January. So with that, the British pound has appreciated slightly, pushing euro sterling down. But you can see here we're just trading basically sideways again, and are likely to hold above the late February low at 87.55. If not, then we could head back down again towards the current March low at 87.19, and then also towards the 200 simple moving average at 86.90. For the bulls to be back in control on this currency pair, we would have to rise above this week's high at 88.65, which doesn't look likely at the moment. Moving on to the British pound versus the US dollar, what we've seen here is that because of the risk-off sentiment to do with the ongoing global banking crisis and the fears of contagion being seen in regards to US regional banks once more, that has led to the US dollar appreciating versus the British pound. You can see here we've dropped out of an uptrend channel, which had been in place since the beginning of March, and are now testing support around the mid-March high, around 122 in that sort of area. If that were to be taken out, we've got some support between the late February lows, highs, sorry, 121.50, 121.40. That's the support area there. But basically, from a technical perspective, as long as we remain above the mid-March low at 120.11, the last reaction low here, the uptrend remains intact with regards to cable. The weaker US dollar also had an impact on commodity markets over the last few weeks, which rallied. And now that the dollar is rising again, we might see some of these advantages being thwarted, and we can see that later on when we look at the price of copper. But let's begin by having a look at the price of WTI first of all, and we can see here crude oil, which had been rising from its one-year low at $64.37 over the last few days and actually hit its resistance seen here just between the December and January and also February lows between $70.25 and $72.64, where it failed, and now it's coming off again. Basically, on risk-off sentiment globally being seen, on the US 2 10-year yield curve also uninverting. And basically, what this means is that the short-term yields drop sharply in anticipation of rate cuts coming out of the US. And as we all know, the US 2 10-year yield curve was inverted for, or has been inverted for many months, and now it's uninverting. And normally when that happens, a recession is on its way. So this has also then led these recessionary fears to the price of crude oil coming off. And we also had yesterday the US Energy Secretary Jennifer Granholm telling lawmakers that it would be difficult to refill strategic oil reserves this year, prompting speculations that the US government would only start buying oil again at lower prices than where they are at the moment. And this, coupled with a robust crude oil supply from Russia, is basically weighing on the price of WTI here. And this is now heading back down again towards the psychological $65 mark. And a fall through the $64.37 level that we saw at the beginning of this week would likely take us down again to the December low at $62.35. So we'll have to see whether we can hold above that recent low. As long as we do, further upside might still be possible with regards to the price of oil. But if we were to fall through at $64.37, then further downside is very much likely to be seen. Moving on to the price of gold. Now, gold has been the great beneficiary of the recent market woes and has acted as its traditional flight to safety investment. And as you can see here, the price of gold after the US Federal Reserve hiked its interest rates and bringing the Fed funds to 4.75 to 5%, hiked its rates by 25 basis points. That then led to further upside in the price of gold being seen and taking us back today towards the psychological 2,000 mark, above which we can see a Monday's high at $2,009 per troy ounce. If that were to be exceeded, then the only upside target we have is the March 2022 high at $2,070. So here, short term, the uptrend also remains intact, provided we stay above this week's low seen on Wednesday at $1,935 per troy ounce. And let's finish up on copper. As I mentioned, copper on the back of a weaker US dollar over the last few days rallied quite strongly from its $8,443 per metric ton low seen in mid-March, and then rallied through the February to March downtrend line, and yesterday closed above it, which is actually bullish. But today it is coming off again on the back of a stronger US dollar. And we'll have to see whether we can hold at this breach resistance line, which has now become a support line and currently comes in around 8,888. Or if we were to fall through there again. If so, then we've got some support coming in between the early February lows and to mid-February lows, and that is around the 8,806 to 8,777 mark. So that would be support again for the price of copper. But again here, from a technical perspective, provided we stay above this month $8,443 low, further upside seems to be likely to be seen. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is AxelR_IG. Good morning and welcome.